Welcome back, students who are taking financial accounting, and in this series of videos we are working on chapter 2, analyzing and recording business transactions, and this is the third video in the theory videos for chapter 2. So in the first one we covered like an introduction as to what the series is about. In the last video we had covered double entry bookkeeping, and so now in this video we're going to talk about making a journal entry. Now, again, the idea is read the textbook, study it, do the homework problems, and watch these theory videos in order to give additional insight into the material in the book. Not everything is covered in the book. Covered in the videos. That is covered in the book. And again, it's to give additional insights. And this is one of these here aspects on how to make a journal entry. The book goes through a 5-step process that in order to figure out how to make a journal entry. But for me, after just so many years, I've developed this way of thinking that I'm going to present for how to make a journal entry. Now, be aware that it's like when you're trying to teach this stuff, it's like, do you present the chicken or do you present the egg first? Okay, in order to be able to talk about concepts, you have to give an example, but then in giving the example, you're circumventing the concepts to a certain extent. Don't get caught mimicking the journal entries from the textbook, because invariably you're going to come across journal entries that you've never seen before, and you're not going to find them in the textbook. And if you don't understand somewhat of a process in order to be able to decide as to how to make that journal entry, you're just not going to be able to make it. Okay, so if like for example, let me get my pen here. Let's say you're going to pay rent, and your rent is $1,000. Okay, and you're going to pay the rent. This here is July, so let's say you want to pay August's rent. All right. Oops, August, and it's August 1st, and you want to pay your rent for the month of August, and you're going to pay cash for that rent. Okay. The book will have a journal entry that'll have the date, August 1st, whatever year, and it will have a debit to rent expense, and it'll have a credit to cash for $1,000. Okay, and you'll see that journal entry in the book. So and this again is just an aside from let's say you're taking a test, and the test kind of like goes and says, okay, Johnny Smith is going to pay $3,000 for rent using cash on, say, September 27th for the month of October. Okay, make the journal entry. Okay, well, you'll be able to go back in the book and you'll see this and you'll say, okay, well, oh yeah, here's a 10/1 XX, because I know that's the date. Okay, so now your journal entry looks like this. It's 10/1 XX, and I can write debit rent expense, and instead of $1,000, I'm going to be able to write 3,000. And I have a good journal entry. And yeah, that's going to happen. Okay, you'll be able to do it that way. But what you're doing is you're mimicking and you're copying a journal entry, but you don't understand why this journal entry is what it is the way it is. Okay? So then when you come across something along the lines of let's say XYZ company, XYZ company had unearned rent revenue in the amount of $4,000 for the month of, I don't know, March. Make the journal entry. Okay, well, you're going to go back into the textbook and you're not going to find this entry in the textbook. Okay, and I just made this up, but this is a transaction that can occur in the workplace, and you're not going to know how to make this journal entry because you're trying to copy it out of a book instead of understanding how to make the journal entry. Okay, now, it's not to scare you and whatever, but realize that even this basic journal entry right here follows a certain set of process, or a thought process in order to be able to make it. But because it's a very, very common journal entry, we have a tendency just to take it in and then just memorize it almost, and just repeat it. And for some entries like rent expense, that's just fine. Okay. But you should understand the underlying concepts that apply to this journal entry, so that when you do have a journal entry that you don't know about, you're able to make that entry, right? Because you understand the underlying concepts on how to make it, right? Now, again, the textbook presents a 5-step method for making journal entries. I'm not going to go over it. I'm going to go over what works easiest for me. It's the way I think of it. Whether you adopt my process or not, that's up to you. But I found that, after making journal entries for so many years, that I was able to break down into this, thinking process, which allows me to make the journal entry and what I like to call back into some of the information to make sure that my journal entry is correct. And this is rather important because what happens is I find that when students are given information, what they end up doing is they always end up, not always, but most of the time, they start with the second half of the transaction. And they struggle in trying to determine what the debit should be or what the credit should be. They may be able to figure out the account relatively easy because it might say something like, note payable, okay? Or, and they know that there's a note payable general ledger account, so they, oh yeah, they can figure out the note payable, but they struggle to determine whether it's a debit or credit. And the reason why they're doing that is because they're starting with the second half of the transaction, all right? Instead of working through a process. Now, in my process that I'm going to share here, okay, this is not 100% foolproof, but I am going to, you're going to see why this works in an awful lot of the circumstances. In a business, most of the time, we're using cash, and that makes up the vast majority of our transactions. Okay, but after we use cash, the next most used accounts are accounts receivable and accounts payable. Why? Because we buy things on credit, or we sell things on credit. Okay, and if you consider those just those three accounts, they're making up upwards of 85, depending upon the business, 85–90% of the transactions that happen in a business. So you're only talking about like 10% of the transactions where you're not going to follow those accounts exactly, and you're going to have to start thinking a little bit. But you'll see when I'm making the journal entry that it says, an account that makes the most amount of sense. And instead of, it's something that you probably already know and that you don't have to relatively think about. So you start with that account that makes the most amount of sense, and you're still able to back into the last half of the entry and get a correct entry. So let me kind of go over the procedure here. right? The first thing that I always ask myself is, one, does this affect cash? Okay, and my answer to it is either going to be a yes or no. Now, why do I ask that question? Does this affect cash? Well, one, because it's the account that's used a majority of the time. And also, if you look at the accounting equation, assets equals liabilities plus equity, okay, we know that the normal balance of an asset is a debit. If you want to know what that is, go back to the last video and watch the theory on the normal balance of an asset. Just like we know the normal balance of a liability is a credit, and the normal balance of an equity account is a credit. Okay, so we know that cash is an asset. Okay, and if our cash is, if our asset increases, we're going to debit it. So if our cash is increasing, meaning we had some number, okay, we had some figure, and if it increases, say $20,000, okay, well, since cash is an asset, we're going to debit it, okay? So when I'm making a journal entry, I have to have debits equal my credits. So if cash is an asset and my cash is increasing, I'm going to debit it, okay? Now, if my cash was decreasing, well then yeah, I would credit it instead, okay? If my cash was decreasing, I would credit it instead. Okay. But now here's the thing, whether it increases or it decreases, and let's just go back to the increase part. We're saying our cash is increasing 20,000, so that means since cash is an asset and I increase my assets on the debit side, okay, so I'm going to debit cash for 20,000. And from the theory, we know that our debits have to equal our credits, okay? So if I have a debit to cash for 20,000, that means I have to credit something else for 20,000. The question is what? Okay. Now, it all depends upon the the transaction itself. When am I, what is that transaction about? And a lot of, sure, sometimes in the transaction, the way it's presented, like for example, if it said, oh, someone is buying we're selling $20,000 of common stock. Okay. Well, I would immediately know that the ledger account I'd be using is common stock because, that's a ledger account I have. But it's better to ask the question, if the business is getting $20,000 in cash, well, the other half of the entry, is that going to be an asset? Is it something I'm going to own? All right. Let's take take supplies, let's say. Okay. Well, supplies is something that I can own. Right? So it would be an asset. So I would look underneath the asset accounts and I would look at all of the accounts that are listed under that, and then I would just choose the correct account. Okay, so what I'm doing is I'm going to look at the categories of accounts first. I'm going to decide if it's something I own, if it's something I owe, is it an investment in the business, is it a sale, or is it a cash outflow because it's part of the operation of the business. Well, if the transaction had been $20,000 of stock, well, that's an investment in the business. And so I would look under an equity, and then I'd look at the accounts and determine which account it would be. Okay. Now, sure, if it's common stock, yeah, I'm going to have a common stock account underneath equity. But what if this was not a corporation? What if this was a sole proprietorship? Okay. If it was a sole proprietorship, and it said, $20,000 was being invested by, Mary Jones. Okay. Well, now what does that mean? Okay. Well, is it an asset? No, it's not something I own. I mean, yeah, the cash is what I own, but what about that other half? What about Mary Jones? She isn't buying, the business doesn't get an asset, and it's not something that's owed, but oh yeah, it is an equity account because it can't be a sale and it's not an expense, so it has to be an equity account. Well, underneath equity, right, you're going to have Mary Jones Capital. You're going to have Mary Jones Withdrawal or Draw Account. Okay, you might have Tom Smith Capital, Tom Smith Withdraw. Okay, so you need to decide what category first and then look at the accounts underneath it in order to be able to choose the correct one. In this case, it would be Mary Jones Capital. But let's say this entry was for buying supplies. Let's say we're buying $200 of supplies that we're going to use immediately in the business. Okay, well, if let's say that's a transaction. Okay, so here instead, I'm looking at, my cash account, and I'm asking myself, am I affecting cash? Well, yes, I'm affecting cash because I'm going to buy $200 worth of supplies that I'm immediately going to use in the business, and I'm using cash. I'm not using accounts receivable or accounts payable, all right? I'm using the cash. So what is happening to my cash? Well, cash is an asset, and my asset is decreasing, okay? Well, if my asset is decreasing, right, that means I'm going to credit my cash. So you have your credit to cash for 200, and debits have to equal credits. So that means you're going to debit something else. But the question is what? Okay, if you jump up here and you look underneath, you see an account under assets called supplies, and you, based upon the information you have here, all right, oh, well, and this is why students make the mistake, okay, they immediately look at supplies and they say, oh, this is supplies, so they make the other half of this journal entry as a debit to supplies. For 200, okay, and the issue with that is that entry is wrong, right? It's not correct. Why? Because yeah, they're buying supplies, right? The transaction is buying $200 in supplies that is being immediately used in the business. Well, if it's being immediately used in the business, that means it's an expense. And under your expenses, you're going to have an account called supplies expense account. Okay? Well, you saw the word supply, you see the word supplies and you jump to the conclusion that it's an asset, something you own. Well, it's not something you own because why? You're using it immediately in the operation of your business. So the correct, if you think about the category of account, is this something we own? Well, yeah, we're buying the supplies, but we're using it immediately in the operation of the business. Isn't that an expense? So if you're thinking about assets, liabilities, equity, revenue, expenses, you have to come to the conclusion that, oh, this is an expense to the business, right? Because it's in the operation of the business. And underneath those accounts that are listed under expenses, I'm going to see supplies expense, and that's what I'm going to use for my journal entry. Okay, I'm going to use supplies, oops, get my pen, supplies expense for 200. And that makes my journal entry correct because I thought about the category of account first, and I was just able to back into, I just needed to look at that category and then just choose the account underneath the category, right? There's the category, and then choose the account underneath it. And I can back into, I know it's going to be a debit. Now, I can think about all of the theory behind it, all right? Why? And, in order to make sure that I'm right. I mean, obviously, my cash, like I said, it's decreasing, so I know that cash is an asset here, and that means I'm decreasing it, so it's got to be a credit, okay? And we already saw that. But when we look at, our expense accounts, right, the normal balance of an expense account is a debit. Well, if I have supplies expense, and before that, the balance in that account, say, is $35, and now, when I add the $200 more to it, obviously I'm increasing my supplies expense. Well, the normal balance of a supply expense, the normal balance of an expense, there's the normal balance of the expense. That's a debit, okay? And if it's a debit, that means I'm increasing it, right? And my supplies expense went from $35 to $235. So it was increasing it. So I know that my journal entry of a debit to supplies expense for $200 and a credit to cash for $200 is correct. You know, that's the theory behind it. But I didn't have to go thinking about all of that, okay? When I sat down and I said, I'm looking at cash first, and cash is decreasing, well, then I'm crediting my cash. Well, if I have a credit to cash, if I have a credit, I have to for 200, I have to debit something else for 200. Well, what is it? And when I determined that it was the supplies expense account, okay, that I was debiting, all right, I just automatically backed into, the right journal entry. I didn't have to, keep on thinking further about it. Right, so I'm at 21 minutes here, and what I'm going to do is I'm not finished here with this thought process. I realize that I'm presenting examples trying to explain this, which is taking more time, so I'm going to break here and pick up with continuing on how to make a journal entry in the next video.